So I want you to imagine waking up tomorrow and you just voluntarily fire the single client that brings in like nearly 40% of your company's revenue.
Yeah, just completely cut them off.
Exactly. You just walk into the office, you look at this guaranteed, incredibly stable, high-volume revenue stream, and you just sever the tie. You burn the boats.
It sounds insane, honestly.
Right. But that is exactly the situation we are unpacking today in this deep dive. We are looking at the first quarter earnings and financial documents for Zepp Health Corporation. This is for Q1 2026. And the mission today is to decode how a technology company actually attempts one of those dangerous maneuvers in business.
That pivot.
The pivot. They're trying to transform their entire identity, going from this volume-driven, budget-friendly wearable maker that relied super heavily on a massive partner into a premium, specialized health and fitness brand.
It really is the ultimate corporate high-wire act, you know? And to put the sheer scale of this into perspective for you, let us look at the immediate financial reality they're operating in right now.
Let's do it.
So, for the first quarter of 2026, Zepp Health reported net revenues of $51.5 million US dollars.
Okay.
And that represents a 33.8% increase year over year, which, landed perfectly within the company's own guidance. But the context around that specific number is what makes it so critical.
Because of the timing, right?
Exactly. The first quarter, so January through March, is traditionally just a graveyard for consumer electronics.
Yeah, everybody's broke after the holidays.
Right, the holiday shopping rush is over, consumers are totally tapped out, retail foot traffic just plummets. So to generate a nearly 34% revenue spike during literally the quietest season of the year.
That's huge.
It is. It suggests that this multi-year transformation strategy they've been executing is actually starting to find serious traction with a completely new demographic of buyers.
But, I mean, a top-line revenue bump in a slow quarter doesn't automatically mean the grand strategy is a massive success.
No, definitely not.
Because if you discount products enough, you can always juice revenue, right? You can always have a fire sale.
Yeah, anyone can sell $1 for 90 cents.
Exactly. So to figure out if this pivot is actually sustainable, we really have to bypass those top-line numbers and look at the actual mechanics of their sales mix. And when you look at the historical charts in these earnings presentations, I mean, there is a data point that is honestly staggering.
The Xiaomi drop-off.
The Xiaomi drop-off. If you go back just 2 years, so to the first quarter of 2024, wearable products made in partnership with Xiaomi accounted for 39.4% of Zepp's total revenue.
Almost 40%.
Almost 40%. Today, in Q1 2026, that number is exactly zero.
Wow.
Zero. Amazfit branded wearable products, which is Zepp's own in-house brand now, account for exactly 100% of their revenue.
Yeah, that Xiaomi revenue is completely gone. And that is a massive structural shift for the business because, when a hardware company partners with a giant like Xiaomi to produce white label or co-branded goods, they are fundamentally trading their profit margins for guaranteed volume.
Right, it's like training wheels.
Exactly. The partner provides this massive distribution network and the shelf space, but in exchange, they dictate the pricing. You are effectively a ghost in the machine. You take on all the manufacturing and the supply chain risks, but you build absolutely zero brand equity for yourself with the actual consumer.
Yeah, the customer thinks they bought a Xiaomi product.
Precisely. So by severing that relationship and going all in on their own Amazfit brand, Zepp is basically reclaiming their pricing power. The underlying logic of this premiumization strategy is that you just accept selling fewer total units, but in exchange, you capture significantly more profit on every single watch you sell.
Which brings us to the ultimate scorecard for that strategy, right? The gross margin.
Yes, the gross margin is everything here.
Because if you are intentionally selling fewer watches, you better be making a lot more money on them. And the Q1 documents show their gross margin reached 37.7%. That's up from 37.3% a year ago. And they pulled that off while shipping 0.6 million Amazfit units, which is just a slight bump from the 0.5 million a year ago. So they successfully dropped the safety net. They dropped almost 40% of their historical revenue base, and the margin still went up.
It did. But, if we're being really rigorous about analyzing these financials, there is a sequential nuance here that we absolutely have to address.
Okay, what's the catch?
Well, while the 37.7% margin is a solid year-over-year improvement, it's actually a pretty noticeable drop from the immediate previous quarter.
Oh, really?
Yeah. In Q4 2025, Zepp posted a record-high gross margin of 40.4%.
Okay, wait, so margin dropped from Q4 to Q1.
Yes.
So a skeptic might look at that and say, well, the premium premium pricing strategy is already losing steam.
They might, but you have to factor in the cyclical reality of product releases. You see, Q1 is historically the quarter where Zepp refreshes its entry-level, lower-margin product lines.
Ah.
So when those cheaper units, like the newly released BitMax, when those flood into the sales mix to capture the more casual market, the blended overall margin naturally takes a slight dip.
That makes sense.
It's a seasonal product mix effect, you know? It's not a structural failure of the premium shift.
Got it. And that structural shift is really what I want to zero in on next. Because cutting the cord and managing your margins only works if the consumer actually agrees to pay that higher price.
Right.
You can't just slap a higher price tag on the same old hardware and magically call it a premium brand. Zepp CEO, Wayne Huang, stated that their 2026 ambition is to build a leadership position in something he calls hybrid training.
Yes, hybrid training. This is clearly where they're directing their hardware evolution.
Right. We're seeing devices like the Amazfit Balance 3 and the Balance Ultra, which are targeting users managing strength, endurance, and daily recovery. And they launched the Cheetah 2 Pro, which is specifically engineered for marathon runners.
And the Cheetah 2 Ultra for trail runners, right?
Yeah.
For dealing with unpredictable terrain and, like, prolonged exposure to the elements.
Yeah, exactly. But I have to push back here a little bit.
Okay, go for it.
Because I hear the strategic logic. But when I actually read the product materials in these sources,
Yeah.
my cynical alarm bells start ringing really loudly.
The marketing jargon.
The jargon. The presentation for the Balance 3 leans so heavily on features powered by, quote, hybrid charge energy intelligence.
Right.
And it brings together these metrics called biocharge and life load and training load. I have to call this out. Biocharge. Life load. I mean, this sounds like the absolute peak of marketing buzzword bingo.
It really does.
It's designed specifically to justify a higher retail price. Are we just looking at a standard heart rate monitor that's been wrapped up in this futuristic vocabulary?
I get the skepticism, and it is incredibly easy to dismiss those terms as pure marketing fluff. But let's actually break down the physiological mechanisms those algorithms are trying to quantify, because it's really not just a fancy pedometer.
Okay, convince me.
Let's take life load, for example. This isn't just some arbitrary score out of 100. The hardware is actively measuring heart rate variability, or HRV.
Right, HRV.
Which is the microscopic variation in time between your heartbeats, specifically while you are in different stages of sleep architecture. High variability generally means your nervous system is recovered and adaptable,
Okay.
but low variability means your system is stuck in a state of sympathetic stress, fight or flight, which is likely from overtraining or just poor recovery. So when the algorithms calculate your life load, they are using actual biometric data to quantify your recovery debt. It's a highly specialized energy management system.
So they are moving users from casual tracking, just counting steps, to serious training.
Exactly. They're actively choosing not to compete with generalist smartwatches.
Like the Apple Watch.
Right. An Apple Watch or a basic Fitbit is largely designed for general wellness. They tell you to stand up, they close your activity rings. But Zepp is targeting a completely different psychology. They're building tools for athletes who actually need to know when not to train.
Because a trail runner or a hybrid athlete actually needs precise data on their central nervous system fatigue before they go out and do another brutal workout.
Exactly. They are moving from casual tracking to high-stakes physiological management.
Okay, so the technology is genuinely moving past basic step counting.
No.
But the ultimate test of any product feature is whether the market is actually willing to pay for it, right?
Always.
And there is a specific metric in the Q1 data that suggests they are. The sources note that in March and April of 2026, the premium models of the T-Rex line, so specifically the Pro and Ultra versions, they accounted for nearly 50% of the total T-Rex family unit sales.
Just wild.
Wait, really? A 50% adoption rate for the premium tier?
Yeah.
Usually in consumer electronics, you see this barbell effect where the cheap entry-level models carry the vast majority of the volume.
Yep.
And then you have this tiny, tiny sliver of expensive Halo products at the top. This flips the traditional hardware model completely on its head.
It does. And that 50% figure is arguably the single strongest piece of evidence that the premiumization strategy is actually working. Half of the consumers looking at that specific rugged product line evaluated their options, and they actively chose to pay a significant premium for the most advanced materials and the deepest analytical features.
So they're buying into it.
Yes. It proves that the specialized athletic community is buying into the ecosystem. They aren't viewing it as just a watch. They're viewing it as a piece of specialized athletic equipment.
You use the word ecosystem, and I think that is where the real business strategy lies here.
Absolutely.
Because let's be honest about hardware. It's incredibly vulnerable. No matter how good the Balance 3 or the Cheetah 2 Ultra is, eventually, a competitor is going to release a watch with a slightly brighter screen, or a titanium bezel, or an extra day of battery life.
Always have.
Right. And if you are just competing on physical hardware, your customers will eventually jump ship. So the only way you protect these high-value premium users you just acquired is by shifting the focus to the software and the strategic partnerships. That's how you build a moat.
And you have to build that moat out of data. This is where Zepp is aggressively expanding their Zepp OS and really leaning into Zepp Coach. They are essentially building an AI-driven training guide directly into the software, complete with this massive library of specific hybrid training modes. The goal is to make the hardware a secondary consideration to the software experience.
It's exactly like the concept of data lock-in, but applied to physical fitness.
Yes, exactly.
Like buying the smartwatch is just the cost of entry, like buying a gym membership. But the Zepp OS and the daily physiological tracking they're doing, that's like hiring a dedicated personal trainer who has 3 years of your comprehensive blood work, your sleep logs, your injury history, and the exact pacing data of your last 10 races.
It makes it incredibly painful to quit.
Right. If a competitor offers you a shiny new watch for $50 less, you aren't going to switch. Because it would mean firing the trainer who knows your body perfectly and starting completely over with a stranger who knows nothing about you. That historical data is the actual moat.
That is precisely the mechanism of data lock-in. And Zepp is taking that deeply personal software experience and scaling it through structural partnerships within the fitness industry itself.
The HYROX deal.
The HYROX deal. The most significant move here is their exclusive 3-year global partnership with HYROX.
And for some context for you listening, HYROX is not your standard weekend 5K.
No, definitely not.
It is an intensely demanding, globally standardized fitness race. It combines running with functional workout stations like sled pushes and wall balls. It is essentially the physical embodiment of the hybrid training concept that Zepp is targeting.
And the economics of this partnership are brilliant. Zepp didn't just, buy billboard space at a finish line. They upgraded from a prior regional cooperation to become the exclusive wearable technology partner globally. In the B2, B2C tech world, so business to consumer, this is exactly how you embed yourself into a community. HYRX athletes need to track highly specific intervals and transition times between the running and the strength stations.
And Zepp OS is building software modes tailored exactly to those race mechanics.
Exactly. Furthermore, this deal gives Zepp direct access to a global network of affiliated gyms and influential coaches who train these athletes. Add to that, they're expanding a MassFit athletes team.
Oh, right. They're bringing on elite competitors, like Rory Linkletter, the Canadian Olympian and national half-marathon record holder.
Yes. So when you look at all of that together, you see the strategy. Hardware is just the Trojan horse to get their software ecosystem onto the wrists of highly influential athletes.
Okay, so the product shifts to a premium tier. The software creates this physiological data lock-in, and the global partnerships embed the brand directly into the infrastructure of specialized sports. It is a phenomenal narrative on paper.
It is.
But here is the catch. With building custom AI trainers and sponsoring global fitness franchises, it burns an unbelievable amount of cash.
Oh, yeah.
When I look at the Q1 balance sheet, the actual cost of digging this data moat is glaring.
The financial reality of a pivot this aggressive is always stark on the balance sheet. In Q1 2026, the adjusted net loss attributable to Zepp was $17.9 million.
Wow, $17.9 million.
Yeah. Their GAAP operating expenses, which are the fully loaded standard accounting costs of running the business, rose to $37.1 million. And a massive portion of that, specifically $13.1 million, was poured directly into research and development.
Which is the raw cost of funding those AI algorithms, the Zepp Coach features, the advanced biometrics.
Exactly.
And it isn't just their internal R&D burn rate that they're fighting. The sources outline several major macroeconomic headwinds that are completely outside of their control. They're dealing with elevated costs for memory components, which directly squeezes the profit margin on the physical hardware before it even leaves the factory. Plus, they are facing significant foreign currency headwinds. Specifically, the appreciation of the RMB against the US dollar.
Yeah, the currency translation effect is a classic trap for multinational companies based in Asia.
Can you break that down a bit?
Sure. So the vast majority of Zepp's operating expenses, so engineer salaries, local marketing, overhead, those are paid in Chinese RMB. But when they report their earnings to global investors, they translate those figures into US dollars.
Right.
When the RMB appreciates, meaning it gets stronger against the dollar, it means those local expenses suddenly look much higher on the US dollar income statement, even if the actual day-to-day operations haven't changed at all.
That is brutal.
It is. So when you combine that uncontrollable FX headwind with the
But despite that loss, we have to acknowledge that they're operating from a position of relative stability. Like they aren't staring down bankruptcy tomorrow.
No, not at all.
Their cash and cash equivalents are sitting at a very healthy $103.2 million. And there's a detail in the inventory metrics that is actually quite impressive.
The risk purchases.
Yeah. Despite making strategic risk purchases of key components, which basically means they intentionally bought parts far in advance to hedge against global supply chain disruptions, their overall inventory actually decreased to $62.8 million.
Then managing to draw down your total inventory value while simultaneously stockpiling critical risk components, that requires incredible operational discipline. It tells you that they have a very tight grip on their demand forecasting. They aren't just blindly churning out thousands of premium watches and letting them gather dust in warehouses. They're producing efficiently against actual market demand.
But that actually brings me to a massive contradiction in these financials that we really have to resolve. If I am running a hardware business that just posted an $18 million net loss for the quarter, and I am staring down rising component costs and hostile currency exchange rates, the absolute last thing I am doing is spending my cash reserves on anything other than core operations.
That would be the traditional thinking, yes.
Right. Yet the sources show Zepp has retired $46.4 million in debt since 2023, and they have actively used $17 million to buy back their own stock.
Yeah.
In fact, the board just authorized an extension of that share repurchase program all the way out to November 2026. Why on earth would a company operating at a loss devote precious capital to stock buybacks?
It seems entirely counterintuitive, I know, but in corporate finance, a move like that is a neon signal to the market regarding capital allocation and management's internal confidence.
How so?
Well, when a company buys back its own stock, especially during a quarter where they report a net loss, management is effectively declaring that the public market is fundamentally mispricing the intrinsic value of the business.
Oh, I see.
You have to remember why they took the loss. It wasn't a failure of sales. It was driven by aggressive, intentional investments in R&D, front-loaded marketing for the premium shift, and those uncontrollable currency translations.
Right, the headwinds we just talked about.
Exactly. So by choosing to simultaneously retire nearly $47 million in debt and authorize further stock buybacks, management is proving they aren't in a state of financial distress. They are betting that the long-term profitability of the premium high-margin hardware, combined with that sticky data lock-in of the Zepp OS, will generate returns far exceeding these short-term investments.
They're literally putting their money where their mouth is.
Yes, they are putting their own cash on the line to say the moat they are building is worth significantly more than Wall Street currently realizes.
They burned the boats, they took the initial financial hit, and now they are actively betting on their own survival. Which, naturally leads us to the outlook. Where does this pivot go in the immediate future?
Well, based on management's guidance for the second quarter of 2026, they are projecting net revenues to land between $63.0 million and $68.0 million.
Okay, so a bump.
Yeah, if they hit that target, it represents a 6% to 14% year-over-year increase. It indicates they expect the momentum to continue as they lean even harder into the premium product mix and wield their newfound pricing power.
And that upward trajectory really solidifies the whole narrative we've traced today for you. Zepp Health is a company mid-leap. They recognize the existential threat of relying on a white-label partner for volume. They took the incredibly painful step of walking away from nearly 40% of their guaranteed revenue to establish their own brand identity.
Yeah, they're transitioning from a company that sold cheap hardware into an AI-driven data company that uses premium hardware as a Trojan horse to lock specialized athletes into their ecosystem.
Which is wild to think about. If you are an endurance athlete, you know the anxiety of overtraining before a major event. Zepp is essentially betting their entire R&D budget on the premise that you will gladly pay a premium to eliminate that exact anxiety.
They are, which, leaves us with a final unavoidable question about the broader tech landscape.
What's that?
If Zepp is successfully proving that this highly lucrative specialized niche exists, if they are successfully integrating into massive communities like HYROX and proving that consumers will pay a premium for deep physiological recovery data, at what point do the generalist tech giants decide this market is too valuable to ignore?
Oh man, Apple and Google.
Right. Apple and Google have nearly infinite resources.
Hmm.
How does a mid-size, specialized brand defend its carefully built data moat when a $2 trillion behemoth decides they want to offer hybrid training biometrics natively on their flagship devices? Zepp dropped the safety net to forge their own path, but now they have to prove they can out-innovate the giants who own the broader ecosystem.
They survived the pivot. Now they have to survive the giants. That is a fascinating place to leave it for today.